In this video, I'll show you how to trade ICT fair value gaps like a pro, as I'll reveal all secrets and rules to only trade the high probability ones. If you know my style of teaching, I don't like to waste anyone's time. That's why I'll first show you what we'll cover in this video. But before starting, I did my best to summarize my 5 years of experience in trading in this video for you to become a better trader. But if you cannot watch a video that will definitely make you a better trader till the end, then just know that most likely you won't be able to become a profitable trader, as trading also requires focus and discipline. Anyway, we're going to be starting first with why we need high probability fair value gaps in the first place, and the difference between an imbalance and a fair value gap. A lot of people actually mix between the two, even though sometimes a fair value gap can be an imbalance can be a fair value gap, but we can actually look at them in a different way. And then we're going to go over the 4 rules of fair value gaps. Those are the rules that will make fair value gaps much higher probability, and each rule we're going to go over the rule and then examples. So starting with the first one is going to be the manipulation phases, and the rule 2 we're going to go over the importance of higher time frame. Rule 3 is going to be about higher time frame fair value gaps, as they will cause lower time frame fair value gaps to be violated. This is very important. I mean, if you just watch everything and not this one, you will still fail trading fair value gaps. Then the 4th rule, and this is the relationship between fair value gaps, inducement, and overlapping period arrays. Very important, and I'll end the video as those are the 4 major secrets and rules of fair value gaps. But there are some other ones that will definitely make you trade better fair value gaps, and that's going to be at the end of the video. So we're going to cover 6 more confluences, including time, market structure, volume, range, and that's also a market maker's model. Then the second fair value gap, and third candle fair value gap. All of those things is going to be in the extra confluences sections. That's the bonus that's going to be at the end of the video. So make sure to watch the video to the end. I promise you that even 5%, 10%, that's going to make you a better trader, even with a small percentage. So starting with the why do we need to actually focus on high probability fair value gaps? And I mean, the answer is simple, right? Because we want to have a higher win rate when trading. We always want to be on the good side, on the right side, right? But we got to look at this in 2 different ways. Right, the first one is going to be the difference between expansion and consolidation. Now, the market in general goes over those 2 phases. Sometimes it expands and then sometimes it consolidates, same as trending and ranging, the same thing. So why do we sometimes enter of a fair value gap, and what happened is price touching that fair value gap and immediately reacting, going higher, retracing, going higher, but then it's actually trending after going to that fair value gap. On other times, what happened is price touching that fair value gap, goes up, maybe a small move to the upside, keeps going lower. Maybe if we enter from here, that's a stop loss, and again it goes higher and we think that it's actually time, and what happened after is taking that low again. And you see, if you enter of those 3 zones here, it's going to be 1, 2, and 3 losses. So what is the difference here? Why sometimes we have this scenario and another times we have this scenario? That's because in this case we deal with high probability fair value gaps, and in this case it's not the highest probability fair value gap. That's why we only need to focus on high probability fair value gaps, because we want to trade fair value gaps that actually establishes expansions as price reach those fair value gaps. And I don't want to be falling into that consolidation inside of the fair value gap, because that's going to lead to multiple stop losses hit inside of that consolidation inside of that fair value gap. Another reason is fair value and imbalance. If you have heard about the terms liquidity sweep and liquidity run, a lot of people actually, when talking about highs and lows, we always say, oh, we want to look at a sweep above a high or a sweep below the low. So that's just assuming that every high is going to be swept and every low is going to be swept. But in reality, there are some highs that are broken above. There are some highs that get a liquidity run instead of a liquidity liquidity sweep. So we actually take that liquidity above a high and then maybe continuing in the same direction. There is no need for a sweep. That's why we don't have turtle soup or we don't have liquidity sweep all the time. It can actually run the liquidity or it can sweep the liquidity. Same thing here when we're talking about fair value and imbalance. Fair value means that, okay, price is going higher. We are in the same direction. We are creating this fair value, also an imbalance, but fair value focuses more on offering a fair value that price comes to and then pushes in the same direction. So if the fair value gap is bullish, it means that we are offering fair value, a better value, a discount to keep pushing higher. An imbalance sometimes, and I do call it this way because an imbalance can be used as a target. I want price to reach there, but I'm not looking to enter off there. On the other hand, a fair value gap is a zone that I'm looking, maybe I'm targeting to, but I'm also looking to enter of that level or of that zone. Imbalance is, oh, I have this one and it doesn't need to be this way, right? Maybe we're actually going up, and there is an imbalance here. I'm targeting that one to be filled. So most likely an imbalance is a zone in the price action where I'm looking for price to actually fill that imbalance or fill that zone, and it's okay to disrespect it. I'm not looking for an entry of that zone. So that's the main difference between fair value and imbalance. That's why we need to focus more on fair value gaps, and it's always going to be with a trend. And the 4 rules that I'm going to give you today, those are the ones that are going to differentiate between just a normal imbalance or a fair value gap. Into the first rule, and in my opinion that's the most important one. If I was asked to pick one of those rules, one of the 4 rules that I'm gonna go over, this is going to be the first one, because this is, in my opinion, the first step in order to validate a fair value gap. If I have this, then most likely it's a high probability, but I'll still need to look at the other 3 ones as well as the confluences. Actually, based on the experience that I have, I could see all of the rules happening at the same time and evaluate if the fair value gap is valid or not. So what is the first one? It's 1 to 2. So 1 or 2 manipulation phases needed to validate a fair value gap. Now we have different manipulation phases or stages. One of those is the liquidity manipulation. The other one is fair value gap manipulation. Now you might ask, what is the difference between the two? Let's start first with the most known manipulation, and it's this one here, the liquidity manipulation. So when looking at fair value gaps, I need to have a liquidity manipulation, and that's going to be either one of those, either sweeping a high or a low. So when we are creating that fair value gap, I want to look to the left in this case. So going back in time, I want to see, do we actually, so if I'm creating here, do we have a liquidity sweep here? If yes, then that means we have at least one phase of manipulation. So sweeping a high or a low, that's one type of manipulation, or in other words, one form of manipulation, because those are the types 1 and 2. But the first type has 2 forms. Okay, so sweeping high or low, or it could also be reaching a fair value gap. Now some people would ask, oh, why is reaching a fair value gap considered a liquidity manipulation when in reality it's a fair value gap? You should understand that when price goes inside of a fair value gap, it's taking liquidity and sweeping liquidity. In reality, in the lower time frame, it's going to be more visible in the lower time frame. So let's say we have a fair value gap like this. In this case, the high of the fair value gap is a liquidity level, and we might have some other liquidity levels inside. If you wanted more information about this, make sure to watch my theory on fair value gaps, the video that's going to be suggested to you right now. So sweeping high or low or reaching fair value gap, that's the first thing, and this is the most important one. So this one is the first priority, then comes the other one, fair value gap manipulation. What does that mean? It's the process of creation of fair value gap that is before the liquidity manipulation phase. So we have this already, but before we also take a step back in time and we look, do we have a fair value gap that is created? And most likely it's going to be on the wrong direction, the opposite direction of the real fair value gap. Then if that's there, then that means we also have a fair value gap manipulation, and we have 2 phases of manipulation in this case, which makes this a much higher probability. And what is the main purpose of the fair value gap manipulation? Is actually to induce traders to enter on the wrong direction, creating liquidity, and then using that liquidity to actually enter trades on the right direction. So we have a bullish fair value gap before reaching a liquidity level. That bullish fair value gap, a lot of people would enter from, then price might just go higher a bit and then goes lower. So something like this, fair value gap here, and then creating another fair value gap here, disrespecting the first one and taking all the liquidity from there, using that as a fuel to actually go lower after. Okay, so using the inducement fair value gap or the fair value gap manipulation as a fuel to enter on the right direction. This is the first rule, and again, the most important one. You could, trade and look for a fair value gap with one manipulation phase, but if you could find the two at the same time, that's going to be a much higher probability one. So looking at gold on the 4-hour time frame, what we can see is that there are a lot of liquidity sweeps. For example, we got one here, that's a liquidity sweep, but we had no fair value gap created. Now, one example is, let's say, we can see that what happened is price sweeping liquidity and then having a fair value gap here. So just by looking at this sweep and this fair value gap, we can see that we have one phase of manipulation here, creating a fair value gap, making this a higher probability fair value gap. But what you don't see is that before price reaching and creating the first manipulation phase, what we had here is this fair value gap being created. And this fair value gap pushes price higher. So a lot of people actually entering here and then putting their stop losses below the low here or inside of the fair value gap or maybe below the fair value gap. But what we can agree on is that there is a lot of liquidity created here. That's the thing we agree on. So we have a lot of liquidity, sweeping liquidity, and then creating another fair value gap. This now becomes the highest probability fair value gap, and this is creating more liquidity to push price lower from here. You see? That's the two-phase fair value gap. Now, same thing here. You see this one here. Do we have a liquidity manipulation? Yes, there you go. That's the first phase. Second phase, and that's the one that happened before, but it's less important compared to this one. What we see is we have a fair value gap here created. This one is to induce people, and the new one here used to, that's the valid one. There you go. And that's how we get high probability ones. Again, you could only look for one phase, but if you could have two phases at the same time, that's going to be much better. Now into the second rule, and it's not less important than the first one, actually very important. It's the higher time frame alignment. And in simple words, and this is known to a lot of people, but the problem is not a lot of people are patient enough to wait for this. And sometimes they just take random fair value gaps instead of waiting for the one that is highest probability. And you see, all of the rules that I'm going to be mentioning today, they're kind of related to each other. So when you master one, you become good at two, and mastering two becomes good at three, and it goes on and on. And then when looking at the bonus or the extra confluences, they make you better at all those rules. So that's why you need to watch the whole video. That's why you need to master all of the rules. Now this one, higher time frame alignment, what does that mean? That means as we are, we have this higher time frame bullish fair value gap, as you can see, higher time frame bullish fair value gap. This is a lower time frame bearish fair value gap. You see, as we are approaching, so let's say we're looking at 15 minutes as lower time frame and 4 hour as higher time frame. This is a 4 hour time frame. As we're approaching that 4 hour, we created a bearish fair value gap. Doesn't make sense to short a currency when we are inside of a bullish fair value gap, even though sometimes it can work, and even though sometimes you can make money off it, but it's not gonna work in the long term. It's not gonna work in the long run. That's why when we are inside of a bullish fair value gap, we ignore any bearish fair value gaps in the lower time frame and focus on an alignment in the order flow between the two time frames, the higher time frame and the lower time frame. For example, what we see is, bearish fair value gap, we ignore this one. We're not really interested in this one. What happened after is price going up, and we have, you see, this bullish fair value gap that is supposed to push price higher. That's the higher time frame one. We create a lower lower time frame fair value gap of that higher time frame fair value gap. What does that mean? Now we have an alignment in the order flow between the higher time frame and the lower time frame. That's why this becomes now a high probability one, while this one is a very low probability one. And why? Because actually the bullish one aligns with the higher time frame, while the bearish one in the lower time frame is against what the higher time frame is telling us. And remember that higher time frame is the best. Higher time frame is going to tell you the real story, and the lower time frame is going to be the noise that might actually prevent you from making money, and not only this, but make you lose money. Now here is the time frame alignment. So if we're looking at trading 15 minutes, then we're going to look at 4-hour order flow and 4-hour fair value gaps in order to validate our fair value gaps on the lower time frame. Keep it simple. Stick to those time frames, stick to what I taught you right now, and you'll be most of the time in the right side of the market and in the right curve. Now again, looking at the recent price action of gold, and for example, marking this fair value gap, as we discussed, it's a high probability, and you will know also why it's higher probability one when we look at the other confluences. So this is one fair value gap that is bullish. We also have one fair value gap here that is bearish, and that's also a high probability one in one kind, because it did not have the manipulation phase, the liquidity one, but it has other ones like the fair value gap manipulation. So those two, we're going to go to 15 minutes because we're using the 4-hour. 15 minutes is going to be the lower time frame and show you what happened in the lower time frame. So we're going to be starting with the bearish one first because it happened before in the price action. What we see is that always we had, as we're approaching that 4-hour, if you don't pay attention to the 4-hour when trading the 15-minute, you'll fall into this trap. And what is going to happen? You see, as we're going into that fair value gap, if you don't see it, you'll see that we have a fair value gap here that actually took liquidity and another liquidity here. And it had all types of, not the fair value gap one, but there is one that is delayed here. Forget about this one, but this is a high probability one where we had a fair value gap and we had a market structure shift. So this should become what? A high probability one. But paying attention to the 4-hour, we're actually approaching a 4-hour fair value gap that is much stronger than all of the 15-minute fair value gap. And what we need to see is what? An alignment between the two time frames. So we're forgetting about those bullish fair value gaps. Those are all traps, and this is how the manipulation fair value gap happen. Not this one, because this is going to be against the 4-hour, but this one where we create this fair value gap, this one now become with the order flow. So entering here, stop loss maybe above the high, and that's going to be the valid one. Now you see the same thing happen here. As we're approaching that one, we also create another fair value gap, and this one is, you know, a very strong one. It has a lot of confluences, and you will see also in the extra confluences section. But this one was actually approaching a 4-hour fair value gap, and price reacted to that one, gave some reaction from this fair value gap. But the real one would be the one that is aligned with the 4-hour, which is this bearish fair value gap. Entering from here, stop loss above the high, that's going to be the valid one. We always align ourselves with the 4-hour when using the 15-minute. We always align ourselves with the 1-hour when using the 5-minute, and then the same as the time frame alignment times that I gave you. Now, same thing here. We have this bullish fair value gap. You see how we were actually very aggressive. Breakout structure here. We have one fair value gap here, second, third, 4. So 4 fair value gaps. And we have this one where we get a reaction of, definitely we had a lower time frame confirmation here. But all of this is invalid. Why? Because we are in a 4-hour bullish fair value gap, which means that we gotta focus more on the bullish order flow to be established in the lower time frame in order to validate this. Now you see we had even if you look at what happened after, we are pushing higher. Most of the bullish fair value gaps are going to be respected, right? A lot of them actually. We have this one here respected, pushing higher, another fair value gap here respected, and then it keeps going higher. Why? Because we're actually part of this 4-hour fair value gap that is very strong, and we need to align the order flow. So you see bullish fair value gap on the higher time frame, we need to look for a bullish fair value gap also, but in the lower time frame. That's the time frame alignment, and that's the importance of the higher time frame. Rule number 3, and that's going to be no higher time frame fair value gap above or below. And what does that mean? And again, you see how it's all about higher time frame and lower time frame and the alignment between the two, but in this case it's a little bit different. Sometimes you look at the 15-minute, and what do you see is this fair value gap here that is bullish, and this one that is bullish, and they have all of the confluences and all of the rules apply that we covered in this video. But then there is something missing. There is something that you're not really paying attention to. And what is that? There is maybe a hidden, or it could be visible, a hidden 4-hour fair value gap that is below all of the lower time frame fair value gap. So lower time frame fair value gap here, lower time frame here, and then higher time frame here. When you switch to the higher time frame, you'll see that there's actually a fair value gap here. Now it could be also part of the 15-minute, or it could be hidden. You gotta understand that higher time frame fair value gaps are always stronger than lower time frame fair value gap. That's a rule of thumb. So this is higher time frame bullish fair value gap, which is this one here, and those are lower time frame. So same as looking at the 4-hour and 15-minute, higher time frame, lower time frame. So in this case, what's going to happen that even if our fair value gaps are valid, price will still go to the higher time frame fair value gap, disrespecting all of the lower time frame fair value gaps. Even if they have all the manipulation phases, if they have everything, price will need to go to the higher time frame fair value gap that is below, and that's going to cause all the lower time frame fair value gaps to be disrespected. That's why you need to always apply your top-down analysis. Who trades 1 minute time frame, for example, that's what you like. You like scalping on the 1 minute time frame. You'll see that there are actually a lot of fair value gaps on this price action leg, and there are some here that are also high probability ones. There's some here, there's some here, and there is one here. So which one do we take? There is one here also, and price respected. You could have had a lower time frame confirmation, for example, but price decided to go all the way up here, disrespecting all those fair value gaps, and that can be also applicable on the 4-hour and the 15-minute, same thing. Now you see price disrespected all fair value gaps in order to come here to this zone, to this fair value gap, and then react off it. Why did this happen? The reason is that this zone here is a 15-minute fair value gap. So price disrespected all of the lower time frame fair value gaps because they matter less. The most important one is the 15-minute fair value gap in this case, and it can be also seen here. For example, we can see that in this price action leg we had a lot of fair value gaps going up, but price came to this one here. And why? Maybe there was a 5-minute fair value gap here, and it keeps happening the same like this in all different time frames. Same thing here. You see how price actually came back to this zone where there is no visible fair value gap. There is liquidity, yeah, but it's not even that visible. It's not really significant on this time frame. But what happened is price actually, even in this big price action leg, how many fair value gaps we had? We have one here that is really high probability, actually 2 consecutive ones, and we had one here that has liquidity also. So this one, and then one here, and one here. Why did price disrespect all of those in order to come here? Because this is a 1-hour fair value gap that will cause all of the lower time frame fair value gaps below it to be disrespected and violated, and that's why we need to always check the higher time frame. The fourth rule is inducement or overlapping. If you're looking for something to really take your fair value gaps to the next level, that's going to be the one, inducement or overlapping. Why do we need this in the first place? You know, when looking at fair value gaps, it acts as a line of defense, or it acts as, you know, a level of support or level of resistance, even though it's not the exact meaning of support or how people actually tend to understand it, but it supports price to go higher, or it pushes price lower. For example, when we have multiple lines of defense overlapping or happening at the same time, that's going to be a higher probability. In other words, multiple confluences at the same time. That's how you get high probability conditions. The fourth rule says that we need to have an inducement or an overlapping to make a fair value gap a higher probability. Now, what is inducement? It can be in 2 different forms. The first one is going to be, let's start with this one. It's a fair value gap that has liquidity above or below. So in a bullish scenario where we have this bullish fair value gap, there is liquidity that is very, very close to the fair value gap. That is an inducement, IDM. Okay, that's one form of it. Another form is when price comes to and, you know, touches the fair value gap partially, started going higher, and then needed to go lower again, taking that inducement. Now that's also another type of inducement, which is usually a first mitigation of fair value gap. It's going to be an inducement. That's the first type. So when we have a fair value gap that has all of the previous 3 rules and have the fourth one either an inducement or overlapping, or sometimes both can be happening at the same time, then that is a high probability one. What is overlapping on the other hand? So fair value gap is what? It's a PD array. When we have more than one PD array that is overlapping also with the fair value gap, that becomes a high probability one. So for example, we have something like this, where we go up, we go lower, and then we break structure. This one, it could have been a mitigation block, it could have been a breaker block, or sometimes it could have been also an order block. When we have this that is overlapping also with a fair value gap, automatically it becomes higher probability, because we have fair value gap pushing price higher as well as the high here pushing price higher. So we have two things pushing price higher other than just one thing, and that's automatically a higher probability one. Now we could also have fair value gap plus fair value gap. So two fair value gap. And how does that look? So we have a fair value gap here that is bearish, now inversed up, and we have a new creation of a bullish fair value gap. So the fair value gap that was bearish, when inversed, it becomes a bullish fair value gap. And we also have a new creation of a bullish fair value gap. Then we have two bullish PD arrays pushing price higher in this case. That's why this becomes also an overlapping, and it is a higher probability one. So focusing on those two types and the different forms below each type, that's how you get really high probability fair value gaps. So looking at gold again on the 4 hour, a lot of examples we have here. So an example of the overlapping, where we have a balanced price range, for example, which is two fair value gaps overlapping with each other. You see fair value gap here, fair value gap here. Where's the overlapping? That's the one. That's one type of it. Now another type is having liquidity, or in other words inducement, near the key level. One of the examples is this one. We have this liquidity where we have a fair value gap below that can be used as inducement, making this higher probability one. Now sometimes it can be even closer or inside. For example, this one here, you see we have this low that is inside of the fair value gap. That's the first mitigation that can be used as an inducement. Now this one has two at the same time. Has what? It has inducement and it has an overlapping. Where's the overlapping? If you can see that there was this order block here that was broken above. This is the last bearish candle before the bullish move. That's an order block. Maybe in the lower time frame it can be a breaker block or mitigation block, and then we have a fair value gap here. That's an overlapping. So you see this zone here is very high probability one. Why? Because we have two confluences here. Now going to another example, we have first of all a balanced price range, which is an overlapping of two fair value gaps. In this case it was not respected, but why? Because we have other inducement here. You see this is a high inside of fair value gap taken here. Same thing here. This always makes the fair value gap much higher probability fair value gap, and also the balanced price ranges. Now you could have asked, where did price react off here, and why did it react? Because we had price respecting a fair value gap here. Maybe the whole thing here is a daily fair value gap, but the most important one is this zone here. You see we had a big fair value gap and we have a smaller one inside. This becomes balanced price range. You can see that price really respect that one, even does not close inside of it, and then keeps pushing lower. So those are the types of inducement. You can go to the chart, practice it yourself. I do have multiple videos on inducement, you can watch those, but this really takes your fair value gap game to the top just using those full rules that I introduced to you, and that can also become much better looking at the confluences that I'll cover later in the video. Now into the extra confluences section, or the bonus, and what I'm gonna do is not go into much details but go over each one quickly just to give you an idea about it. And if I have a specific video about one of those concepts, then I'm gonna guide you to, then I'm gonna leave it in the description, or it's going to be suggested to you. Starting with the first one, which is time. Actually, the time when the fair value gap is created is very crucial. As an example of that is a fair value gap that is created after price taken. So let's say agent session here, price takes agent session in the London session and then goes lower, creating a fair value gap. This becomes a high probability one. A fair value gap created in the agent session usually is a low probability one. Most of the time actually low probability one, unless we had agent session trending reaching a 4 hour, if we're looking at the 15 minute, then reaching a 4 hour fair value gap and then reacting of it. Then if there is a fair value gap here on the agent session, it can actually hold. That's the only scenario where agent session is going to be, having good fair value gaps. For example, we can see here in euro dollar that we had a agent session here. What happened is liquidity sweep into an order block and then creating this fair value gap. This one held, and why? Because we took agent session low and then we are pushing higher now. And now this happened also here. You see, this agent session is somewhere in here. We took the high, we create a fair value gap here, and we reacted off it. Now this happened a lot of the time, but it's not going to be every time because we still need to align the 4 hour. You see here, we created multiple fair value gaps, one here and maybe a few ones above. This one was a high probability one, but price did not retrace back to. And another example is here. Fair value gaps on the agent session are not valid. Maybe keep an eye at the 50% of the agent session. Maybe there is a fair value gap there. It could hold, but overall, you see liquidity sweep of this level as well as the agent session high, and then fair value gap here. That's the one that held. And then we also keep an eye at what? If we had agent session like this, and then we had a sweep of the low in lender session, we create a fair value gap and we respect it, and then we break structure at New York session. We might look for continuation of the London direction. So it could have been something like this, where we had fair value gap on London here, and it is with the direction of the Judah swing or the liquidity sweep that happened of the agent session. So sweep going up, a break of structure here, a break of structure here, then leaving in a fair value gap. This fair value gap is also a high probability one based on the timing. In the PM session in the Forex market or near the closing of the daily candle, I don't recommend trading at that time, especially fair value gaps. They don't become high probability ones. That's how time is very crucial when trading fair value gaps. The second confluence we have today is the market structure. So let's say we've been having a lot of break of structure. The recent break of structure is to the upside. Most likely I want to see a bullish fair value gap holding other than bearish fair value gap and enter of it. So I want to really look for price retracing to this range other than creating a new fair value gap and entering short. Why? Because the recent break of structure is here, that is bullish, and I want to continue bullish. So for example, we can see that we clearly have an uptrend. The structure is bullish. Breakout structure, fair value gap. When we have that breakout structure, it just makes our fair value gap much higher probability. Anytime we have something like this where we had price going up, coming lower, and then we had a breakout structure, either that's overlapping or not overlapping, but any fair value gap here becomes higher probability one because the recent structure is bullish. Same thing here. You see, we had this breakout structure here, fair value gap here, kind of holding, but then breakout structure here, fair value gap definitely holding, and then breakout structure here, and it goes the same way. You see, breakout structure here, fair value gap holding until we switch the direction. So for example, here we had a minor breakout structure to the lower side, and this fair value gap also held a little bit, not that much, but then the main or the major structure is the bullish one. So one breakout structure can really make a big difference for a fair value gap here. When we are against the market structure, it becomes much lower probability. The third confluence we have is the volume. Now, how do we combine volume and fair value gaps at the same time? What I do actually is using this indicator, which is SVP. You can find this on TradingView, session volume profile. Those are the settings that I have. I'll be only using the POC, and this level here on the price action actually shows you where most of the volume was for that session. So I can see that for this day, most of the volume was at this level. So starting this day, this is where I'm going to keep an eye at. This is the 1 hour time frame. Now what I'll do is, if I have this level here, for example, this is where the most volume was for this day, and then the next day when it starts, if I come to a fair value gap that is close to this level, so we can see that we have a fair value gap here that is kind of near and close to where the most volume was, and all of the rules applies to this fair value gap, it becomes a high probability one. Now we can see that we have this zone. This is where the most volume was. This is a POC, and we have a fair value gap that is kind of close to it. If it is really like aligning with it, it's going to be better, but it tells me that a lot of volume was around this level. There was actually a lot of volume, and it shows you here also in the volume profile. So you can use this or just simplify it with this line, and that's where price react off, because that's where most of the volume was for that day. And same thing here. See, sometimes even price respect this level like exactly there, for example here, but sometimes there's no fair value gap. So you see exactly respecting that level and pushing higher. So for example here we have the POC level and we have fair value gap here, price respect that fair value gap. So if we have POC kind of aligning and close to a fair value gap, that becomes a higher probability fair value gap, just like this. And we can use the volume, also the volume profile, to look at the zones of high volume. So if the fair value gap is around this high volume level, also we can consider it. Now into the fourth confluence, and this is going to be quality of the range, or in other words, the market maker's model range. That means I'm not just looking for any random fair value gap anywhere in the price action. I'm mostly looking for what? A clear high or low, because we know that price actually trade from internal to external or external to internal. That means fair value gap to a high, fair value gap to a low, and low to a fair value gap or high to a fair value gap. So when we see price going up and then come into a fair value gap, I see that, okay, we have a fair value gap here that is bullish. When we have a clear high, use as a target and use as high probability liquidity level, this fair value gap becomes high probability one, because we are in a context of a market maker's model. We know that we are pushing to this. That's the fair value gap that's going to be pushing the price higher, other than just going something like this where it's really random, and sometime we can have something like this where price is going up, coming lower just like this, and then creating a fair value gap maybe here, and we don't have a clear context. Sometimes even a price comes here, this context here is not enough for you. It's not even maybe a one-to-one reward to risk. So we always need to be aligned with high probability ranges where we have a clear fair value gap and a clear high or low as a liquidity level. How does that look in the chart? That looks like this. We're coming to that fair value gap. Where is the nearest low to that fair value gap? It's this one. That's how we move from internal to external. Now same thing also here, fair value gap. Now we ask ourselves, when price comes to this fair value gap, do we have a clear high to target? Yes, we have this one. That's going to be what? The move of internal to external. That's the thing. Now same thing here. We have this fair value gap. Price comes here, external is here. That's where we target. That's how the market moves. Even if I go to monthly time frame or weekly time frame, that's going to be the way. If you see here, we had a fair value gap, and we always ask that question, do we have a clear range here? Yes, we have a high, we have fair value gap, and now it looks like we're taking the high again, and that's what happened here. So when we have a clear range like this, it's going to help us a lot to know what to target. Again, same thing here. Fair value gap, even though it's a small one, but then targeting the high that was created before price reaching that fair value gap. The fifth confluence that we have is the second fair value gap. What does that mean? That means if I'm having a fair value gap here that is bearish, for example, and I can see prices come into this bearish fair value gap, and then it creates another fair value gap that is also bearish, we have a clear order flow here that is to the lower side. That means I can actually trust this fair value gap that is created by following this order flow here. So price will come to this fair value gap and push lower. Now we could have two variations of this. We could have one time frame, which means that this is a 4-hour fair value gap, creation of a 4-hour, or this is a 4-hour and creation of a 15-minute. Both of those work, depends on what you really want to get out of it. I mean, if you're looking for bias or another fair value gap to enter off, then that's going to be the 4-hour. If you're looking for an entry, then it's going to be the 4-hour 15-minute. It depends on what you're looking for. So if we look at this here, we can see that price is respecting a fair value gap here and then creating an order flow to the upside, creating another fair value gap. So this fair value gap is created by respecting another one. That's going to be a high probability one. Also look at the second fair value gap in the 15-minute. I mean, let's switch to 15-minute in this case and see, do we have fair value gap respecting, creating another fair value gap? Actually, if you can see, we have fair value gap respected, creating another fair value gap. And this one was also respected. Another example, if you can see to the downside, for example, this one here, we can see fair value gap respected, creating another fair value gap, and also this one respected, even though it went above it a little bit, but it's still respected. Now this one, fair value gap respected, creating another fair value gap, respected again. You see how we have more opportunities on the 15-minute? So this can be actually a model by itself, the second fair value gap entry. The last confluence that we have, and that's the sixth one, the third candle. Actually, I do have a full video about this if you wanted more information. So we're going to be avoiding the fair value gap that has a third candle that is opposite to the direction. What does that mean? Let's say we have a bullish fair value gap just like this. Now, what if the third candle was actually going lower, just like this, and creating a very small fair value gap. Let's assume that this is a bearish candle. So see how it looks? It looks like this one was really ready to go lower, even though it has a higher probability to fill the fair value gap, but it does not have a high probability to respect the fair value gap. We're not really interested in. Now, how does this look on the chart? Let me show you how. So what you're seeing here is this fair value gap here. Even though it worked, but you see a lot of wicks here, and we're not going to be trading this one, even though it kind of held. But the reason is, you see, bearish fair value gap, going higher, creating a fair value gap here, but this third candle was really ready to go lower. So you see how it really closed even with no wick to the lower side. It means that it's really willing to go lower. So that's the reason why we don't trust this type of fair value gap when we have third candle going lower like this, because it's really ready to just go and take the low again and then create another fair value gap. This here, if it was a fair value gap, I would not take it. What I want to see is a fair value gap that has kind of a consolidation at the third candle and not really that expansion candle, that big one.